The most important concept for investors, fundamental investors, is something called the margin of safety. This idea was articulated by Benjamin Graham in two books, first in Security Analysis and second in his book, The Intelligent Investor. Now, Graham is thinking about this a little bit differently than we think about it today. Graham's first writing in the 1930s and 1940s, so we think about it a little bit differently in modern times. But what Graham said is when you're valuing a stock, when you're trying to figure out the private worth or the justifiable value of a stock, you're inevitably having to try to predict the future. And of course, the future is unknowable. So what you want to do, according to Graham, is you want to first use a conservative valuation. You want to use conservative assumptions. And for Graham, that really meant focusing on balance sheet values and on historical or near-term historical earnings. And then secondly, Graham said, you want to pay a price, and this goes for stocks specifically, but you want to pay a price that's less than that valuation that you came up with. And that difference between the value of the stock according to the appraisal and the current market price, that's what Graham calls the margin of safety. And when you have a margin of safety, you've got a cushion, and also that bargain price can lead to a very favorable return.